The global reinsurance industry saw dedicated reinsurance capital decline in 2022, the first contraction seen since AM Best tracking began. Here to discuss a new report on the subject, part of AM Best annual look at the global reinsurance industry, is Dan Hofmeister, senior financial analyst. And Dan, how does AM Best measure reinsurance market capital?
Our process is really twofold. It's a summation of our estimate of traditional reinsurance capital and then Guy Carpenter's estimate of third-party capital. So on our end, to calculate the estimate of the traditional reinsurance capital, what we do is we analyze the BCAR data from all of the top 50 reinsurance groups. We then take a haircut on that top 50 group based on how much premium they're allocating towards reinsurance and how much premium they're allocating towards other lines of business in their underwriting portfolio. And then we assume that that group's about 90% of the total market. That allows us to kind of gross that up and get to a market traditional capital number, which we then combine with the Guy Carpenter estimate to reach that total available capital.
Now, the report notes volatility in the most recent estimates of traditional reinsurance capital. What is driving that?
Yeah, so there's a number of factors in 2022 specifically, most notably the rising interest rates, which we've talked a lot about in prior segments. The equity market volatility as well has really led to some significant mark-to-market losses on the investment side in 2022. Now, underwriting results have improved among the reinsurers, and that's been able to mitigate some of those losses. However, there's another main factor, which is a lot of the capital has begun to divert to other markets. Large reinsurers are starting to write more primary business, more specialty business, and that seems to be more of a long-term trend that we've recognized over the years. And some that some of that capital still remains displaced as of 2023.
You mentioned multiple factors impacting capital levels. How does this reconcile with group's risk-adjusted capitalization?
Yeah, great question. So as far as risk-adjusted capital goes, it's remained supportive of where the current balance sheet strength assessments have been. And that's to say that we haven't had any balance sheet strength-related downgrades in the reinsurance sector. However, we have witnessed some deterioration of capital utilization, which is how we measure excess capital within the market. And while we believe that a lot of the investments will recover and alleviate some of that burden through 2023, there is an added level of risk for the reinsurers if they encounter some type of large liquidity event, such as a Florida hurricane or an earthquake of that nature.
Where does AM Best see traditional reinsurance capital for the remainder of 2023?
Yeah, so we anticipate a recovery of the capital loss, partial recovery of the capital loss within 2022. Now, reinsurers are posting solid underwriting results, and they have recouped some of those investment losses. But there still is that diverted capital into other lines of business that we haven't seen quite return. On top of that, although it is a hard market and everyone seems to agree with that, we haven't seen new capital enter the market in a meaningful way quite yet.
Thanks, Dan.
Thank you.
That was senior financial analyst Dan Hofmeister. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.